We will start our discussion. This is the class for CMA part 1. In part 1 we have 5 main topics. One topic is budgeting, planning and forecasting, which is the first lecture today is about budgeting. We have 4 lectures for cost accounting. We have 3 lectures for financial accounting, and we have 2 lectures for performance management and 2 lectures for internal controls. So in one subject we have around 5-6 subjects. General purpose of doing CMA is to make you capable to run a good business, because as a business person, as a CEO, as a general manager, as a manager operations, you should not be expert of anything, but you should have enough idea, sufficient idea about the processing of the organization. Every organization should controls, should have auditing, should have accounting, should have costing, should have human resource, performance management, how to get the performances. This is the scope of the management. That's why this CMA part 1 majorly focuses on these 5 subjects. Today I will discuss how to analyze and forecast. Forecasting means prediction in future. What are the techniques? If I say next year will be very good, so what is the definition of very good? This is we don't know, right? So we have to define what is very good. But if I say that the next year will be 25% better than the last year, it makes more sense. That's why we study analysis forecasting technique by using mathematical formulas. We'll start our discussion with correlation. Co is a Latin word which means two, relation of 2 variables. How it is useful I will explain. And regression. Then we will move forward to the learning curve analysis. Recently time series is removed, so we will move towards expected value, sensitivity analysis. And the last, we will discuss how to think broad and long by using strategic management, and how to apply the balance scorecard, means the company is balancedly managed and going successful financially, customer are happy, you are spending in your employees, you are a learning organization. This is always the part of the balance scorecard. And in the last we'll see what is a strategic planning, means how to think in a long term by using certain kind of techniques. The first thing is correlation and regression. We have forecasting method. Forecasting means predicting the future. For example, in 2015, you are thinking about 2016. In 2016, we are talking about 2020, government of Dubai has a vision of 2020, government of Abu Dhabi has 2030, United States has a vision of 2050, a new global world. So everyone is thinking broad, long, and for that thinking, because thinking is the first thing which is going to give you a direction. For example, if we want to do CMA, this is our forward thinking, because there are a lot of people, they are sleeping, they are not studying, they are not trying to change their own selves. So the first thing that makes you different is your planning, is your action, is your execution. So planning is really important. That's why we forecast. As I told you, forecast can be 2 ways. One is theoretical. I can say next year sounds very good to me. The other is the next year we are going to chase 50% more sale in comparison with last year. So we have 2 methods. One is called qualitative method. It's more about quality. It's relying on the manager experience and intuition. The other is quantitative methods. Quantitative is more about mathematical models and graphs, formulas, any kind of mathematical simulations, mathematical models that if we use, it will give more assurance to the reader that we have used some mathematical logics to prove our forecast for the next quarter, year or different years. Let's start what is correlation. Co is a Latin word, means two. Relation of two variable is really important to understand. I'll give you one example. Suppose you are a financial controller, you are a CFO, or you are a CEO, and you are thinking forward and you are thinking that next year your sale will become double. Now this is one variable, sales, but we should logically analyze that how sale will become double if we will, on the other hand, we will not do anything. For example, I can enhance my sales by advertising. So advertising and sales, they are related. I want to, if I have a very good manpower like minds, in my company, they will make things very fine, right? You know, what is the difference between Microsoft and any soft is Bill Gates, the mind, you know. Steve Jobs for Apple is one guy. So if you have a right guy in your company, in your partnership, or in your life will become so attractive and so workable, right? That this is the combination that we find as a correlation. So we test the relation of advertisement with sales. If we feel that when we advertise, sale increase much, so we say, okay, these are correlated. So this later in part 2 will study one topic called portfolio management. Like if you have money, for example, we have $1 million. So financial analyst says, or portfolio management says, that don't put your eggs in one basket. Means don't do one business. Split the money into different businesses. So in case one business is down, you can have another business on board who can save you, right? So that's why correlation is a really important topic in our managerial language. But for us as CMA students, it's pretty simple. We should know what is a correlation, what are the behaviors. It is denoted by R. I will read it for you. Correlation is the foundation of any quantitative methods of forecasting, and it's a strength of linear relationship between two variables. When we say linear, mathematics goes around a line. We say this is a line. So if you are into line, around the line, this is a linear relation which is defined, predicted, and matured. Yeah. Expressed mathematically in terms of coefficient of correlation. So we denote coefficient of correlation with R. R tells us how we are related. It can be graphically depicted by plotting the values on a graph in form of a scatter diagram. Scatter diagram is a form of a graph which uses dots to show your ups and downs. The value of R ranges from 1 to -1. So means if you calculate the correlation, either it will be +1 or either it will be -1. -1 is perfectly oppositely correlated, means generally like, you know, husband and wife, -1. One wants to sleep, the other wants to go for shopping, something like this, as a domestic example. But if it is in newly married cases, of course, is different. It is +1, you know, R is equal to 1, means as you are thinking, the other is thinking as well. In commercial example is, if you buy a share of Do and Etisalat, if they are R is equal to 1, means as the Do share will go up, as Etisalat share will go up. -1 means as Do will go up, Etisalat must go down, right? So this analysis help us to do different kind of businesses. We should do businesses which has different returns and they go different ways, because if two businesses goes in the same way, one business is down, the other will also be down. So you have to choose two different businesses. They can save you from any kind of difficult times. Okay, I will show you by the graph how